Hey everybody, it's Nicole Benjamin, your host here at Seeking Alpha to bring to you another episode of Portfolio Pulse, where as the name suggests, we're keeping a pulse to all the big financial moves happening in the market. Now for today's episode, I'm joined by none other than analyst Dilantha De Silva. Thank you so much, Dilantha, for joining us today.
Thank you for having me, Nicole. It's nice to be here.
Absolutely. Now, I want to talk about it. You've been on the Seeking Alpha platform for a few years now. 2018 was the year you started with us. So tell us a little bit about your background in the finance space and how you got started.
So I've always been involved in the investment management industry, and while working as an analyst for one of the largest family offices in Dubai, where I reside, I decided to take a leap of faith and publish an article on Seeking Alpha, which I had already been using to dive deep into the companies that I was following. So then things went from one to another, and after about 800 articles, publishing 800 articles on Seeking Alpha, I think I've become a better investor and an analyst, sharing my opinions on Seeking Alpha still. So
I love that. Now, I see you've written your most recent article about ServiceNow, debunking the two biggest bear arguments. So I want to dive into that. ServiceNow's valuation multiples have collapsed from their historical levels. Looking at their current valuation framework, what data points indicate the stock is deeply discounted rather than just a value trap?
Yes. So how I would frame a value trap is by looking at the growth rates of a company, and when it comes to ServiceNow, I would want to look at whether the enterprise demand is shrinking, or whether their contracted values are weakening, or if their product is being replaced by existing customers. If that were the case, I would say the cheapening valuation multiples would be pointing us toward a value trap rather than an investment opportunity. But in ServiceNow's case, the opposite is actually happening. If you take a look at the last quarter, revenue grew about 25% year over year, and remaining performance obligations grew 21%. It actually pushed the total RPO to about $29 billion. And if you take a look at the largest customers with an annual contract value of over $5 million, it grew from the number of customers actually grew from 533 a year ago to 658. So the opposite is happening for ServiceNow as opposed to what you would expect from a value trap. So the earnings multiple has contracted from about 60, the forward earnings multiple rather, from 60 to about 23. But on the other side of the coin, you have a growing company, you have a growing business, customers are signing new orders. So I think that's a good investment opportunity in a value trap.
Many investors were spooked by this noticeable gross margin drop. So with that in mind, what specific accounting drivers reveal to you whether this is a margin decline or, it's a broken business model?
Yes, good question. So this is where I think we need to separate accounting noise from real operating pressure, because if you take a look at the gross margins on a GAAP basis, subscription gross margins declined by about 650 basis points year over year. But this is where you need to dig deeper into the earnings report, where you find that out of the 650 basis point gross margin decline, about 400 basis points can be actually explained by acquisition accounting. So if you take a look at the gross margin profile, you would see that this acquisition accounting had a lot to do with the margin decline rather than real operating pressure. This is where you will need to look at non-GAAP subscription gross margins. It shows that the real decline was by about 250 basis points. So that is actual real operating pressure that is stemming out of ServiceNow's expenditure on AI inference cost, basically AI costs, as the company is transitioning into a more AI-friendly orchestration platform. So that is actually the real pressure that we are seeing for about 250 basis points, whereas the bulk of the the gross margin pressure that we saw during the quarter came from acquisition accounting. That is just noise. I think investors need to look beyond that.
Well, I also want to ask, SaaS momentum has really taken a beating since the AI boom, and there's a lot of bears that are arguing this massive beating. From a customer and contract standpoint, what metrics show that ServiceNow is expanding its enterprise versus losing ground to AI?
Yes, I think the biggest pain point for ServiceNow has been the rise of AI agents. But if you were to be honest, if AI agents were taking business out of ServiceNow, we would rather be seeing, a collapse in revenue growth, a collapse in subscription revenue growth rather. But if you take a look at their RPO, remaining performance obligations, it actually rose 21% year over year. The current portion rose 21% year over year to $13.3 billion in the last quarter, pushing the total RPO to $29 billion. So this is where I think investors need to look at what the customers are actually doing rather than listening to the market noise. So the customers are extending their contracts with ServiceNow. So AI agents, they can take some of the business away from ServiceNow related to repetitive tasks like, resetting passwords. But the bigger picture is ServiceNow is positioning itself as an AI orchestration platform that would help all these thousands of deployed AI agents be managed really. We have to manage the identity access, permissions access, workflows and exceptions, audit trails, or whether it be compliance and AI agent accountability. So there needs to be a platform to manage, orchestrate these frameworks, workflows. And ServiceNow is emerging as the topmost choice for that in the market right now. Yes.
Now, there has been mixed reviews despite the Q2 estimates, surpassing those milestones. That stock price is kind of just like, for some people, and others, they're like, okay, we'll see what we're working with here. But what operational metric or growth signal must ServiceNow hit next to kind of convince the skeptical analysts to revise their targets upwards?
Yes, I think right now the market, including myself, we are looking at proof that AI is actually additive to the business. So I think a few things need to happen here, a few catalysts rather should emerge here for the stock to re-rate. So the number one catalyst that I'm looking for is a stabilization of gross margins. So because like you said earlier, the declining gross margins have actually spooked investors, right? So we need to see some stabilization here. How that might come is in the form of when these acquisition accounting noises past us, I believe we would start seeing some gross margin stabilization. And I think the market would be willing to reward ServiceNow when they realize that the acquisition spending spree is over and done and dealt with. And the second thing is we want to see AI-driven annual contract value surpassing $1 billion, which actually did during the second quarter. But we need to see this momentum getting carried forward into the next quarter. So I'm looking at 20% plus AI ACV growth. And if you can achieve that alongside some gross margin stabilization, I think we are looking at a very good opportunity for ServiceNow to, get back some of its lost charm and then invite investors to invest in their company.
All right. Well, Dilantha, I think we'll wrap things up there. Thank you so much for joining us today. And for everybody listening in, go ahead, click his article, see if ServiceNow might be right for your portfolio, and we'll catch you here next time.
Past performance is no guarantee of future results. Content is offered for information purposes only. Any expressed views and opinions do not reflect Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank.